Hi, I'm Kathy Kraysler, CMO of ValueSetters, and today I'm joined by Rob Burnett, Director of Business Development for Netcapital, and we're going to go over some frequently asked questions by issuers and investors. So, Rob, thank you so much for joining me today.
Thanks for having me, Kathy. I'm happy to be here.
Let me first start by asking you, for companies who want to issue securities online via private markets, could you please explain the various SEC exemptions?
Sure, happy to help. So there's a couple different exemptions that are now available to all private companies would let them raise capital online and generally solicit, which is a huge advantage, especially these days in the times of COVID where face-to-face meetings are hard. So the foundation of this is the Jobs Act, and specifically Title III. That established a rule called Reg CF, or Securities Exemption 4A6. And that allows private companies to submit something called a Form C and an offering statement, which is about 28 questions about the company, making certain disclosures, all pretty basic. And in return, they can list on a funding portal like Netcapital and raise up to $1,070,000 from anybody, whether or not the investor is accredited, things like that. And so it gives companies a whole lot of freedom to raise capital online, generally solicit, and turn all your friends, family, customers, and all of the retail investors out there into investors in your company. So it's really exciting. It's kind of a revolution in the securities space. Alongside that, there's something called Reg D 506C. And Reg D has been used historically for private placements where companies do private fundraisers more traditionally from accredited investors. 506C still is limited to accredited investors only. So someone still needs to have a high net worth of over $1 million or income of over 200K. But it does allow for general solicitation. So companies like Netcapital, what we can do is we can do a side-by-side offering with a Reg CF 4A6 and a Reg D 506C, and combining the two, companies can generally solicit, so they can advertise, they can host events, they can host demo days, they can tell the public that they're raising money, and then they can just allocate to either exemption, either non-accredited investors or investors investing small amounts into a Reg CF, and then larger accredited investors can fall under Reg D. So it gives companies a lot of flexibility, again, to take advantage of those that general solicitation and the kind of the power of the internet and the power of advertising and marketing to fund their companies. The third exemption is Reg A and Reg A plus. And this is, some people call it a mini IPO or an internet IPO. It's a little different in that you can raise up to either $25 or $50 million from anyone, from the general public, and you can generally solicit as well. But the requirements to do so are much more stringent. So companies need audited financial statements, for example, and also unlike with Reg CF and Reg D, where companies simply make a filing with the SEC and then can start fundraising, with a Reg A plus, the company needs to submit their documentation to the SEC for comments. And there's usually a several-month period where they go back and forth with the SEC, and the SEC kind of reviews the offering in its entirety, including price, et cetera. So it can be a much more onerous process, but the result is you get to raise quite a bit more capital.
Wow, interesting. That's a lot to take in. Thank you, Rob.
Yeah, sorry.
No, that's great. Now, so for investors, let's say an issuer is doing a Reg CF or a Reg D on Netcapital. For investors, is the equity that they buy on Netcapital in the form of common stock or preferred or another form of equity?
Sure. So typically on Netcapital, investors would be investing in common stock in the company. Something that's important to keep in mind is that for every investment can be slightly different. So you should keep that in mind, and investors should certainly read through all the documentation. Some companies on Netcapital are LLCs. So you might be buying common units versus common stock that you'd buy in corporations. So that's a subtle difference. And then, each company has its own bylaws, its own operating agreement, which investors should consider reading or understanding to understand exactly what class of stock they're purchasing and exactly what rights and responsibilities come along with that stock.
What happens to a Netcapital's investors' equity if the company later offers preferred shares?
Sure. So companies, especially when you talk about early stage private companies, there's often not just one simple financing to get a company off the ground. It's very common for companies to go through multiple financings throughout their lifetime. where they're going to raise additional capital, raise more capital, grow, raise more capital, grow. And the ultimate goal is that companies continue to grow faster than they raise capital and eventually go public or get acquired. And that's how investors make their return typically. But whenever a company raises more capital, there can be dilution. And so that dilution can happen in a couple of ways. So let's say you own, for the sake of simple math, you own 10% of a company that you purchased on Netcapital. That's usually more than you might typically buy, but for simple math, we'll talk about that. A company might raise on a subsequent round of financing, and you might, you own 10% of the company, but now you might only own 5% of the company. The hope is that 5% is still worth more than your previous 10% because the company's grown from that new investment. But there's a couple of different instruments companies can use to do that subsequent investing. They could come back to Netcapital and they could do another common stock round, in which case you would simply be diluted by the percentage that was sold. If companies do preferred shares, it's going to depend on what the preferred terms are of those shares and how it will affect your stake in the company. Some common preferences are liquidation preferences, meaning that if a company sells, those investors with preferred shares would get the money they invested back before additional proceeds are distributed to the rest of the shareholders. There's also other preferences like board seats or other control preferences where maybe everyone who owns preferred shares, you need a majority of them to approve certain transactions like additional issuances of securities, sales of the company, things like that. And so if a company raised on Netcapital and an investor is invested, and then that company goes on to raise, let's say, a preferred round subsequently, it would depend on those preferences. It's possible that some investors would be ahead of you in terms of getting money. It's possible that some of those investors might have more control over the company than you might as a Netcapital investor. The thing to keep in mind in all of those situations is one, these are companies that most retail investors previously never had access to. So even having access is a huge win for many retail investors. The second thing is it's very kind of common and standard and part of the market that whether or not you're accredited, whether or not you're a VC, when investors come in subsequently and do finances further down the line, they tend to what we call stack preferences. So they tend to have preference over earlier investors, and that tends to happen again and again. And that's very natural in the market. That's not something that people should be too worried about. And the third thing is just that, again, the hope is that even if if you have people ahead of you in the preference stack, the goal for all of these companies is that they continue to grow and that they continue to add market share and add value so that you can get a return. So I encourage investors to think a lot about not what percentage of the company they own, but think about the value of their shares and hopefully then going up over time.
Wow. Thanks, Rob. So that leads me to my next question. Do Netcapital investors receive voting rights? And if so, how does voting work?
Sure. So the way we've done it at Netcapital is it can be onerous for companies to have to get, some of our companies have thousands of shareholders through Netcapital. And it would be inefficient for both the shareholders and for the company to get each individual vote. But we want to make sure that investors have a say, at least some say in the kind of governance of the company. And so what Netcapital does is we package all of our investors into one line on the company's cap table with a single record owner. So if you're an investor on Netcapital, part of that purchase agreement is you're going to proxy your right and your votes to a third-party custodian that's appointed by Netcapital. And that custodian's job is to be the sole record owner of the shares. It's the sole representative of all the shareholders on the company's cap table or operating agreement. And it's their job to kind of vote on behalf of the shareholders as a whole. So as an individual investor, you might not have an individual say in the way the company operates, just like you might not, if you own shares of Apple stock or Tesla or GM, you may or may not be able to vote or have a say. The same would be true on Netcapital, but the interests of the whole of Netcapital's shareholders are, that's the single custodian's job is to kind of look out for those interests.
Excellent.
And sorry, just as a follow-up, investors should understand that they typically own a very small portion of the company. And so you should have a lot of faith in the founding team of the company and their board of directors, et cetera, to make good decisions on your behalf. Because it's hard as a small investor, no matter what company you invest in, whether it's on Netcapital in the public markets, things like that, to have a say in the direction of the company. So investors should be aware of and be comfortable with the fact that business decisions may get made that you might not agree with. But the goal is for the companies to make the best decision they can, given the circumstances, and hopefully continue to grow and provide value to shareholders.
Perfect. So issuers they're not actually giving up thousands of voting rights. It's actually just one line on the cap table and the custodian gets the voting rights.
That's correct.
Excellent. Rob, thank you so much. As always, I'm so impressed by your deep and thorough knowledge. So thank you so much for joining us today.
Not a problem. Happy to help, Kathy.
Have a great day, Rob.
Yeah, take care.
Bye.